Why does a sleek luxury vehicle lease that feels like an optimized business deduction often secretly slow down your long-term wealth velocity? Most high-earning professionals gladly sign these 36-month closed-end agreements, fully convinced they are outsmarting the system through clever commercial tax write-offs. But the hidden danger never appears during the initial honeymoon phase. It arrives abruptly at the absolute end of your contract term. Suddenly, an unexpected wave of rigid contractual liability hits your account, triggered by subtle structural friction engineered directly into the lease. Is your monthly vehicle deduction genuinely protecting your hard-earned capital, or is it merely an incredibly sophisticated institutional balance sheet drain? To understand this subtle wealth erosion, we must examine a mechanism we call the melted asset conveyor belt. When you lease, you are not building equity. You are simply paying premium fees to occupy a rapidly depreciating surface. The underlying core structure of the vehicle is entirely protected by the financial institution through calculated residual value assumptions. Dealerships exploit our natural anchoring bias by highlighting a low monthly cost, while masking the compounding risk of strict mileage restrictions. Every single mile driven beyond your rigid allocation transforms your daily commute into a highly punitive, predetermined contractual liability. The human brain naturally overvalues immediate cash flow preservation, while systematically underestimating the long-term compounding drag of non-equity financing. By focusing entirely on the predictable monthly operational expenditure, professionals willingly overlook the true velocity of structural wealth destruction. Luxury vehicles experience some of the steepest real-world commercial depreciation vectors across the entire global automotive industry. Because you do not own the asset, you bear the entire burden of that value drop without keeping any terminal equity. At contract termination, the leasing company meticulously audits the vehicle condition, weaponizing minor wear and tear into direct financial penalties. This creates a powerful psychological trap, subtly forcing you to roll your balance into another lease just to escape immediate fees. By constantly renewing these short-term agreements, you permanently redirect your investable capital away from appreciating market assets. Even optimized commercial fleet deductions often fail to fully offset the massive structural leak embedded inside these premium contracts. Dealerships intentionally prioritize lease structures because they obscure the true acquisition cost while maximizing institutional back-end profitability. True financial intelligence requires us to look past the deceptive comfort of fixed monthly outlays and calculate the absolute net cost. Only by breaking down the precise arithmetic of residual value adjustments can we hope to escape this sophisticated wealth-draining cycle. In the following sections, we will contrast this popular illusion with a highly optimized capital asset acquisition strategy. Uncovering these hidden institutional traps is the absolute baseline requirement for accelerating your personal capital accumulation. Upgrading your personal financial operating system is the most critical step toward achieving true, uninterrupted wealth velocity. Subscribe to Economecha right now and permanently secure your long-term access to razor-sharp, actionable wealth psychology breakdowns. To truly understand the long-term wealth erosion of the leasing cycle, we must execute a comprehensive, multi-year longitudinal tracking model. Archetype A consistently prioritizes the aesthetic appeal of a new vehicle every 36 months, relying entirely on commercial tax write-offs. Conversely, Archetype B executes an optimized asset acquisition strategy, anchoring the purchase within a structured 10-year capital expansion cycle. By tracking both models over a decade, we isolate the exact inflection point where capital ownership begins to generate baseline equity. The empirical data reveals that the recurring lease cycle structurally caps personal capital accumulation, silently transferring your equity to the dealership. While Archetype A constantly battles rigid residual value adjustments, Archetype B captures the full utility value of an asset past its prime. The illusion of continuous operational expense write-offs quickly dissolves when contrasted against the compounding drag of endless non-equity financing. Every single lease renewal locks the professional consumer into a permanent liability loop, artificially stagnating their overall net worth expansion. Meanwhile, the asset owner repurposes those eliminated monthly outlays directly into compounding market investments, doubling their long-term wealth velocity. This comparative financial analysis completely deprograms the popular myth that luxury procurement via leasing is a superior fiscal strategy. Even under strict single-member business entity guidelines, the real-world commercial depreciation vector outpaces the perceived tax advantage every single time. By looking at the complete 10-year cycle, high-earning professionals can finally witness how institutional anchoring biases skew their day-to-day decisions. Breaking free from this structural cash flow restriction requires a fundamental shift in how we calculate the net present value of transportation. The true penalty is never the monthly payment itself, but the massive amount of ungenerated wealth that never enters your ecosystem. Now that the systemic illusion has been fully exposed, we must transition from passive observation to active economic warfare. To reclaim your financial velocity, you must implement a rigorous scientific environment control tool called the Net Acquisition Threshold Evaluation. This precise mathematical framework isolates the exact inflection point where a corporate tax write-off is completely neutralized by leasing fees. By calculating the exact contractual penalty attached to your annual 10,000 miles limit, you deprogram the anchoring bias completely. Tier 3 exposes the hidden residual value discrepancy, revealing whether the financial institution is offloading an asset deficit onto your business. Your urgent, actionable directive is to open your current vehicle contract tomorrow morning and isolate the specific residual value assignment clause. Run your real-world numbers directly through this three-tiered metric to instantly determine the true velocity of your current automotive expenditure. Permanently deprogram the deceptive marketing psychology that weaponizes predictable monthly payments to mask compounding capital destruction. By shifting your strategy from continuous operational cash drain to optimized equity retention, you secure your foundational wealth velocity. True economic sovereignty is built by systematically eliminating every hidden institutional balance sheet trap that quietly bleeds your capital. Deploy this scientific framework immediately, take absolute control of your capital infrastructure, and permanently master the architecture of money psychology.